Okay, so good morning, everyone. Welcome to this macro snapshot. We're going to focus on the non-farm payrolls numbers. Right, so it is Friday, February the 7th, 2025. Okay, first of all, let's just look and see what the recent employment data has been like in the US over the last few days. It's giving, I would say, a solid sort of overall view. If we look at the employment cost index, which was from about a week ago or so, we saw that was up to 0.9. So the point is that wage pressures are not massively accelerating, but they're certainly not de-accelerating at that point. So that's really what the market is trying to figure out. In the bigger picture is also, is this threat of trade wars and tariffs, is that actually affecting sort of investment in the US, decisions to, sort of to open plants and creating nervousness, and which will eventually lead to a sort of a slowdown in employment and cost pressure. So that's one thing. The other one which we want to look at is the ISM manufacturing. As you can see here, the employment component here was actually pretty good, 50.3. So that was higher than expected and much higher than last time. So the manufacturing sector, at least the survey, is slightly in expansion. So, pretty solid there. Prices paid, again, not going down at all. What did get the market's attention a little bit earlier this week was the JOLTS number. And you can see the headline number here actually had come down from over 8 million to about 7.66 million. So less job openings. Also, the quits level did go up a little bit. You see here the quits level not great, and the layoffs. And anyway, I mean, the bottom line with the JOLTS number was that it seems that there were less openings, less people quitting voluntarily, but not really many layoffs or people being fired. So kind of like a stable situation where employers are not particularly, hiring a lot of people, but people are not being fired either. So kind of a stable from the employer's point of view. And in terms of confidence of the American worker, less people quitting voluntarily. Now, all things considered, that would ordinarily point to a little less confidence in quitting your job voluntarily in order to get a better job and a better paying job. And also the headline number there. So they're a little bit, I would say that on balance, the JOLTS number was probably slightly soft. And then if we look at a couple of other numbers here, we have the ADP private payrolls, which came in pretty solidly at 183,000. I mean, that's not the perfect correlation for the NFP. That came in quite solid. The other thing finally we'll look at is the ISM services. And you can see here the employment number, very, solid 52.3, so above expansionary territory. And initial jobless claims again in the low 200s. I mean, 219,000, a few thousand more than last time. But as I say, recession, you're talking plus 350 or 400,000. So at this point, anything between 205 to 15, 220 is very, very solid. It means that there are not that many initial jobless claims. So overall, what can we say about recent employment data is that I would say JOLTS slightly soft, but everything else not booming, but just solid. And then Powell said, just we're in a solid position, all good. At this point, really, the Fed is just waiting for inflation to go down. Okay, so just a couple of things to keep an eye on. I'm just going to grab some tea here, some Irish breakfast. Two things. We've had, on the positive side, there's been some talk that post-hurricane, there's been some more people have come back into the workforce from some of those areas which had been affected by hurricanes. And then the other thing, of course, is that we had the terrible fires in Los Angeles. And was there any sort of fallout from that of people losing their jobs or at least not working? From what I've been reading, the market's not really expecting too much of a fallout from the LA fires in terms of, more initial jobless claims or people, not working. That seems to have not really disrupted the workforce too much. Of course, the other big thing is the revision. So I'm not going to go into it. I've been reading a lot of articles the last 24 hours. The Bureau of Labor Statistics, once a year, they do a major revision with more sort of precise information. The bottom line here, I mean, I've got a few articles, but I'm not actually going to talk about it too much because the point is that the idea is that for one of the household survey, the idea here is that it's going to lower this month's non-farm payroll employment by 700,000. This is the Bloomberg analysis by their economists by 700,000. And possibly in the establishment survey, it might be revised up a little bit. The point here, guys, is that there's going to be a major sort of revision which could lower the number of jobs. And again, we're not referring to the actual situation. We're talking to the situation in 2023 going into 2024. So bottom line, it does seem that the revision numbers, which are going to come out at the same time as the non-farm payrolls this morning, will be substantially revised lower, 800, 900,000, something like that. So really the question is, will the market sort of have a freak out and go, oh my God, the employment situation's a lot worse than we thought? I don't know. I remember last time they did this, there was a short-term reaction, but I think, first of all, this is old news, and secondly, people who seriously follow the markets have been reading about this and completely are expecting this. So I don't know how much of a shock would be. I guess the only real shock would be something like, instead of being minus 800,000, it sort of came in at minus 1.5 million or something like that. I think the way to look at that is to look at the actual non-farm payroll numbers. And it could almost be like a psychological bias that if the non-farm payroll numbers come in significantly cooler than expected, maybe the market will also latch on to the revisions and say, aha, so the structural situation is not as strong as we thought, plus this specific number is a little bit weak. But if we get a strong headline number, I think the market is going to discount that and say, hey, we sort of already knew, and let's get on with what's going on with the Fed and Trump and trade tariffs and the current situation. So that's sort of my view on that. Having said that, it's interesting to look at. Okay, so let's just look at what's expected today. Have a quick look at the numbers here. Here we go. Okay, so if we look at the numbers, we have, just keep in mind we also have the University of Michigan preliminary for February coming up at 10 o'clock. So what we're expected today is a headline number of 175,000. So that's meant to have weakened a little bit compared to last time. You see, last time 256, so expecting 175. We'll also always look at the revisions. The thing here, we know about the manufacturing numbers. The average hourly earnings is going to be pretty important, 0.3. The Fed wants to see that number stable or at least going down, because remember, the Fed is happy with the overall labor situation. The Fed wants to see inflation going down a little bit, and the average hourly earnings is apart. So if that comes in at 0.2, that would make that market, the bond market, pretty happy, and I suspect even the stock market as well. Just talking about that, we did also get the employment cost. I think we got the employment cost index. Yeah, here it is. We got that a few days ago, which was stable. So the Fed will be looking for a little more progress on wages. Also kind of interesting to look at the unemployment rate, 4.1. And again, this could change because of those massive revisions we're getting from the Bureau of Labor Statistics. But from what I've read, the research I've done, most economists are expecting that to remain basically unchanged. So it's not expecting that to go up 4.2, 4.3. Let's have a look. So key numbers here, unemployment rate, 4.1. We also want to be looking at the average hourly earnings, 0.3, and of course the headline 175 and any short-term revisions. I also like to look at the participation rate, 62.5, because again, with the revisions, there's an idea that the Bureau of Labor, BLS, basically has underestimated the amount of immigration. So there could actually be more people coming into the country than they had anticipated or accounted for, and therefore more people working and more people participating in the workforce. So but of course, the percentage will be of a larger population, so that shouldn't change too much. Okay, let's actually just look at the range of the consensus thing. I always like to look at that. So this is the Economist survey. Let's have a look for the headline number. What we can see here is that the median is 175, so let's call that the average, about 175, 176. What would the high point of the estimates is anything from 240 down to 100. So, a relatively wide dispersion of 140,000. Always like to keep in view the standard deviation. Keep this in mind, 30,000 represents, at least on the survey here, one standard deviation. So you've got to say that, anything within one standard deviation. So let's say from up to maybe 200,000 and down to, let's say, 145,000 is in this sort of little bell curve thing here, is not particularly shocking. The market will start to move more aggressively once we go below about 145,000, or let's say above, let's say 205,000. You get into, and it's certainly anything 2 standard deviations would be 60,000 above or 60,000 below. So that's what the market's expecting there. In terms of market reaction, my own thoughts and doing a bit of research, I've got some stuff. Let's say we get above 230,000. I was looking at Goldman's. They're expecting that only to be like a 5% kind of probability. So low probability, 230,000, which would be essentially about 2 standard deviations above consensus. So about 60,000 above. That would probably that would be uncomfortable for the Fed and certainly unhappy for the bond market because the pricing of about 2 more cuts, we have about 2 cuts, 50 basis points priced in for the rest of 2025. That may cause the market to actually question that and certainly bring that down from 2 cuts to maybe 1.5 or 1.25. So certainly that would hit the front end of the curve. I think stocks would not like that at all. Probably the SPY or the SPX or the ES down probably about at least half a percent, 50 basis points, maybe even a full percent, because that would indicate a Fed which not only is absolutely on hold, but would be cutting. The possibility of 2 cuts would diminish substantially, and even at the margin, some idea of an overheating economy and inflationary pressures, and who knows, maybe a tiny bit of pricing in for the Fed to actually potentially even hike at some point. So the market would not like that. So that's anything over, let's say, 2 standard deviations, or let's say about 230,000. What I think the market really wants is just a nice number in the middle. So let's look at something which could be maybe, I don't know, like a 25% chance, something like about 190 to 230. So something pretty solid, so a little bit higher than consensus, let's say 190, 200, 210, something like that. I think that after all of these threats with the tariffs and a potential trade war and everything, that would definitely soothe nerves, that would calm down the market, and that would give the market like a sort of a higher sort of baseline to say, hey, the economy is pretty strong. So no matter even if there's a bit of a hit to GDP or a slowdown, or maybe a tiny bit of extra inflation or slightly higher interest rates, the market, the real economy is in a very strong space. So I think that like the stock market would actually like that. If we got something, as I say, about let's say 190 to 220, something like that. I think even like the SP would possibly rally. Let's say about maybe 25 basis points up to a percent, something like that. I think that would be a pretty strong risk on kind of situation. In that scenario, I think the bond market would be less happy. I think the front end would, I think all across the board, all across the curve, the bonds yields would rise on that, just on the fact that the Fed, the possibility of the Fed cutting twice or even less would go down. I think basically would go down to maybe 1.5 cuts. I think also what the market would really like would be the sort of Goldilocks number, let's say 150 to 190. So let's say a little bit lower than consensus, or just a little bit, so let's say 180, 190, or 150, 160, something like that. I think there's a very good chance we just get that in the middle, maybe let's say 40%. That would basically be signaling that that the real economy is strong, the labor market is solid, that growth is going up at trend. It's not overheating. We're not going into any kind of recessionary sort of vibes. I think the market would be pretty happy with that. And again, I think the stock market would react quite happily, maybe plus 25 to 75 basis points, so 1/4 to 3/4%. We'll get a nice little rally there. I think the bond market would possibly not react that much to that, and might even review that as sort of reasonable. I don't think the front end should react too much. Like 2 more cuts possibly priced in. Okay, no problem there. What happens if we get a weaker number? So let's say something, less than consensus. Let's say something like 110 or 150. So 110 to 150. So suddenly at that point, you're talking, 1.5 standard deviations below consensus. I think at that point, we would have the question was like, oh, is the labor market cooling? And then people would start to look at like the JOLTS number and say, oh, that was a bit softer. And then, of course, we do have the revisions. So I think the market might not like that, based on the idea that, if there's a cooling in the labor market, that could lead to less consumer spending, which, of course, less earnings by companies and, a gradual slowdown in the economy. The front end of the curve should like that. So, something like the SOFR, short-term interest rates, or the ZT, the 2-year futures should rally on that. And we could even get more than 2 cuts starting to be priced in, 2.5, 2.25 cuts being priced in by the end of the year. And I think in that situation, a negative a number like that, as I say, about 110 to 150, I think the stocks SPY might go down, let's say maybe 0.5%, something like that, 50, 60 basis points. I think that could be a possibility. And finally, the final scenario for you, which I think is low probability, maybe just like 5%, let's say less than 110,000. So a very weak number. And keep in mind, consensus is 175. So if we've got, let's say 110, we're talking just over 2 standard deviations. So that's, just about 2.5 standard deviations down here. If you look at the curve here, compared to consensus. And I think then the market would start to say, whoa, maybe there's actual decisions have been delayed on the basis that companies are very nervous about investing in case there's going to be tariffs and a potential trade war and less global trade. And really it's almost like a structural fear starting to hit investment and companies. So I think the stock market wouldn't like that at all. And I think at that point, we might get a relatively solid sell-off in the SPY, something like maybe 1% or, 1.25%, 125 basis points, something like that. On the other hand, the front end of the curve would probably love that and would get some kind of a bull steepening there. So the front end yields down quite substantially. Just talking about the Fed, let's just have a quick look here at what's priced in. It's about 50 basis points from memory. I haven't looked this morning. So if we look at the US by the end of the year, yeah, the market, no, it's not 50 yet. It's only 42. That's interesting. So any dovishness, that could definitely go up to 50 basis points or 2 cuts. So far, by the end of this year, we're pricing in 1.6 cuts. Again, the maximum is about, just over 2 cuts by halfway through 2026. So definitely on a dovish number, we could price it up to, by the end of this year, something around about 2 cuts, which would equate to about 50 basis points. The other thing, those who follow, interesting, I want to look at Canada here, guys. We also have the Canadian employment data here. And we know that Canada has a 1-month reprieve from Trump for tariffs. But the point is that is not a permanent reprieve, and that tariffs could be imposed if things go wrong over the next 3 or 4 weeks. If you remember last time in Canada, we had a pretty strong headline number of 90,000. It's expected to be a bit weaker this time, only additional 25,000 jobs, with an unemployment rate, creeping up 6.8. So the Bank of Canada will be looking at that. The Bank of Canada will want to be seeing this number coming down, and we'll want to see this number kind of solid, because there was even some talk of an emergency cut. At the height of the tension with Trump, a week ago, it's like, oh my God, maybe the Bank of Canada will come in and do another emergency cut. That has dissipated that fear. But certainly if these numbers in Canada come in very weak, there could be some chatter about, maybe a slightly more aggressive future path for the BOC. Other things to think about as well is just a couple of things. I think at about 10 o'clock, we get from the ECB, Lagarde mentioned this the other day, they're releasing a sort of an academic paper, an ECB internal report on R-star. R R-star, as you know, is the neutral rate. It's the interest rate, which is neither accommodative, loose, supporting the economy, nor restrictive, kind of pushing down on the economy and tightening financial conditions. So it's interesting because Lagarde basically said, and a couple of other people, I think even ECB's Lane said the other day, that they still regard their current policy stance as being a little bit restrictive. And the implication for markets is that if it's still restrictive, that they have more room to cut. Okay, so they can still cut. So it's interesting, this thing on R-star. And let's have a look at what their estimate is, because even though it's academic, and Lagarde herself said the other day that what did she say? She said the so-called neutral rate is neither a target nor a goal, something like that. But the point is, if R-star is revised upwards, the market might take that as slightly hawkish. That could put some downward pressure on the German bunds, which could put upward pressure on the yield, which could be a euro positive. So that's something to be looking out for. And if we just look at, let's say, for example, the euro chart here, which I will bring up. If I can, let's have a look at euro. So you see the dollar, the dollar has, it's come off a little bit, kind of just stabilizing last day or two. But the point is, if we get sort of slightly soft data today from the US, and we get revisions which are like even more sort of negative than expected, and on the same point over in Europe, we get this whole idea that the neutral rate, the ECB thinks the neutral rate needs to be revised upwards, which would be euro positive. We could see a little bit of downward pressure on the dollar. I mean, I personally think that around about the 107 level which is sort of the top of the trade range in that recent low here. What is it? 10, well, basically 107. 106.97. I think that's going to be a bit of a base because at this point, we also had Besant yesterday, the new Treasury Secretary, reiterating that it's Trump and his policy for a strong dollar. There had been some thought that Trump wants a weak dollar to aid exports, but Besant yesterday definitely said, no, we definitely, in theory anyway, he's saying that to the journalists, we want a strong dollar. He also calmed the markets yesterday by saying that for the foreseeable future, he doesn't see any need to sort of increase issuance. So that's kind of a nice calming influence. Everything else in the White House seems to be a bit chaotic, but the cent is calming. So the dollar had a bit of support on that. Keep in mind, we do have some bond issuance. We have bond auctions next week, early next week, which could start to put some pressure on the bonds. But just to say, if we get weak data, I do see a bit of room for a correction here in the dollar index. I don't think it's going to be massive. And concurrently, that means that if we look at over the euro, I think, again, if we have a revision higher for our start and we have significantly weak data and revisions coming out of the US, I think, the euro could maybe test up to at least like the 104 level, maybe 104 and a half up a little bit. But I think structurally, it's still a short. We're just trying to, I mean, personally here, we're trying to, get this level 105 or even more beautiful would be 106. So that's probably a bit over optimistic because I think ultimately the direction of the euro is to weaken against the US dollar. I'll probably leave it there, guys. Just something I just wanted to quickly show you. This is from Goldman Sachs, which may not be of interest for you. Basically, what they're saying is just their numbers in terms of the bond reaction here. They're saying a very weak number, less than 100K. They're saying that the short-term interest rate, so this is the SOFR June 25, would go down by 12 basis points. So that's obviously going up in price. And if you go out to the 5-year, 15 basis points off, 10-year, 30 basis points, to 30-year, 6 basis points. So really what they're saying is that a very weak number would heavily, would be great for all bonds, but especially the very front of the curve. So you've got the SOFRs June 25 and December 25 here, and the 5-year, that's maybe the one. On the other hand, if we get a hot number, a plus 200 basis points, 200K, you can see here that at least in the interest rate trading desk from Goldman Sachs, they're saying that should leave again to sort of underperformance in the front end. So let's say December 25 SOFRs up 10 basis points and the 5-year up about 12 basis points. So if you consider that a tick is about, let's say, about 3 to 4 basis points, depending on the product, we're talking 30, 40 ticks down in the 5-year bond. So all that to say that they think most of the action will be, between, let's say, the stirs and the 2s and the 5s, and not such a reaction in the long end. Although, of course, a very weak number would be a pleasant surprise for the 10-year market as well. Okay, guys, I'll leave it there. What else? I think that's about it. No other data. No, I'll leave it there. Let's all get ready for non-farm payrolls. So have a good day and have a wonderful weekend. We're talking again on Monday. Thank you.